All right. Welcome to Let's Just Invest Part 3. I am so ecstatic that you have made the decision to choose the path to wealth, and now we are right on the cusp of putting it all together and printing our initials on the wall of wealth. It is anticipated that there will be another stimulus check sent out within the next few weeks, so right now is the right time to get this investing game going or to build on what you already have. You can find links to part 1 and 2 below, and after this presentation, you will be ready to take advantage of what the market will present us in the coming weeks. With that said, let's just get to it. On today's agenda, I will briefly cover 4 reputable brokerage firms that have not only proven to be useful in providing tools to help you make solid investing decisions, but they also provide some pretty awesome funds and additional products that may be of interest to you. After that, we will go over a few do's and don'ts to help keep you focused as we finish putting the plan together. Those topics will be followed by 4 equities that I mentioned I will provide to you in part 2, and then we will cross the finish line with the final steps before you are released into the investing wild. But no worries, you will now have a 3-part series here to assist you as you dribble down Wall Street and go up for the uncontested investment dunk. Go Nuggets. Okay, so platform number 1 is going to be E-Trade. Now, this is the brokerage account that I currently use, and it has been amazing for me. I became a customer by default since Capital One/ING decided to change their focus, so I have been with them a few years now, and I have no complaints. Customer service is very responsive, and execution of orders have always been prompt. If you decide that this is the platform that you want to use, please set up an account using my referral code shown in the below description. The next platform is the highly respected Vanguard. Vanguard has a spectacular track record for hosting mutual funds and index funds at extremely low cost. Prior to doing the research for this series, I had not found any funds cheaper than what Vanguard offers, but the competition has become very fierce over the last couple of years. It's tough to go wrong with choosing this platform. Then we come to Charles Schwab, another brokerage whose reputation precedes it. This is the one company that I have found to offer funds and products a smidge cheaper than Vanguard. The index funds are generally right at or above Vanguard funds, but I believe they have at least one that beats the Vanguard equivalent. This is definitely worth consideration when doing your research. And finally, we round our list out with TD Ameritrade, another great option, especially when beginning to invest. TD Ameritrade provides resources that can be used according to your level of experience, such as the rookie level, the scholar level, and the guru level. Very beneficial regardless of what you're looking to do with your investment career. Now, I did cover these rather quickly, but most platforms are very similar in how they work. They are only separated by their proprietary products, their fees, and the tools available to you to do when doing research. If you are still feeling a little antsy when it's time to create your account, send me a message or an email, and I will gladly help you set it up free of charge. So overall, you have a plethora of choices when it comes to choosing what company you want to use to hold your wealth. I know there's some of you out there that are saying, hey, what about Robinhood? What about Stash? What about Acorns? And I would answer those questions by saying there's absolutely nothing wrong with any of those platforms for simple investing. But I do highly recommend choosing a reputable full-service brokerage because of the educational tools, the perks, and the availability of equities at your disposal. Since we are building wealth, let's just choose the vehicles that will zoom us across that $1 million finish line with a little bit of style. Cool? Cool. So now we come to a few things that I recommend you do to keep your investments on track and on autopilot. The first is what is referred to as dripping. This stands for Dividend Reinvestment Plan. When this is turned on, it takes your dividend payments and automatically reinvests them into the same stock that just paid you. So instead of this payment hitting your account and you taking it out to pay a bill or buy lunch, you continue to accumulate more shares of your stock and allow your money to keep working for you. I highly recommend using this option, especially in your accumulation phase. Next, we have limit orders. This is what has saved me multiple times when I couldn't get into my account to place an order, or if I was getting caught up in the hype and talk about a particular stock and couldn't decide if I wanted to buy now or wait to see if the price dropped before I bought it. With this option, you pick a price that you want to pay for the stock, and when that price is reached, your brokerage automatically executes the order, and you get a cool notification that you are now the proud owner of said shares. This is another great set it and forget it method to help keep you focused on obtaining the share price that you want to pay and or your desired dividend yield. And lastly, I want you to make sure to always do your due diligence. I can't stress this enough. In part one, I offered guidance on things to look for to help pick a stock. In part two, I shared choices for different types of accounts to use. And today we discussed a few options for choosing a brokerage. Everyone's situation is different, and we want to make sure that you're getting the most from your money and thereby hitting your goals in stride. Take the time to look up a definition, ask me, or ask someone you know if you're unsure about anything. Just like you don't go into a store and just grab any size shirt off the rack and hope it fits when you get home, you also want to check the tag on your investments to make sure they fit comfortably before the time comes for you to use your funds. Okay, now for the three things not to do and to look out for. The first is not known by a lot of people I've had conversations with, but it is of utmost importance when buying and selling your shares. It's called a wash sale. A wash sale occurs when an investor sells or trades a security at a loss and within 30 days before or after they buy another one that is substantially similar. Now, I honestly can't tell you what is considered substantially similar, but I would think it would be something like Pepsi and Coke, Walmart and Target, or Visa and MasterCard. This is yet another great opportunity to do some due diligence if you're unsure. The biggest thing to remember, however, is that this only happens when you sell at a loss. So if you find yourself selling because the price is dropping and you want to get out to cut your losses, just make sure that if you plan to buy this or a similar stock again, either wait 30 days or look further into the similarity of what you just sold and what you plan to buy. It wouldn't hurt to consult a financial advisor in this particular case. Our next no-no is do not overpay on fees. This goes back to the expense ratios and any funds that you might buy that are being managed by someone else. Remember to keep those fees under 1% and preferably under 0.5%. Most if not all brokerages have waived trading fees, so each time that you buy or sell a stock, there should be no fees involved. A few years ago with my ING account, if I wanted to say buy $100 worth of Old Republic insurance, I had to pay $4.95 to make that purchase. So instead of the full $100 going into my investment, only $95.05 went into my investment. It doesn't seem like much, but after 4 or 5 trades, you start to recognize how much of your wealth is being stripped away just for you trying to do your future self a favor by investing. But nowadays, that shouldn't be a problem. I just want you to make sure that the brokerage you pick gives you free trades and any other perks that will contribute to your wealth, not take it away. And probably the most important of these three things, and perhaps in all of investing, is don't invest off of speculation and hope. This series and many other similar teachings are at your fingertips to learn how to make sound investing decisions and enjoy the fruits of your labor. You will always hear about the next hottest stock or what Warren Buffett did, or just simply think you have a good idea. And you might. And Warren's picks may still be beneficial by the time you hear about them, but picking a stock just because you think or hope it will do well, or because it sounds like a good idea, isn't the best way to make your selections. Of course, you can get lucky once or twice, but do you really want to gamble on your future when you have the means to ensure it? I'm going to go with a no here, and I'm hoping you are too. Use the tools and education provided to you, and let's make it happen, Captain. Now, before I share a few of the equities that I have been investing in, I want to give a couple of shout outs. These individuals and organizations have not only supported my efforts with this series, but given me honest feedback and motivated me to keep on keeping on. The first is Mrs. Brenda Shelton. She is an investment coach specializing in investment basics and also the founder and president of the Women for Wealth and Abundance and the Prosperity Investment Club. Her husband, and family have always done great things, and I wish them continued success. Next is the World Data Science Institute. They specialize in consulting, research, and training using data science as a service. The training and guidance I have received from this institute has been invaluable and helped me to reshape my investing strategies to achieve my goals faster. Please check out their website to see what's coming up next in the world. I wish them much success as well. Okay, so the moment we have all been waiting for. I will now share with you 3 stocks and 1 index fund that are all parts of my portfolios and have fared very well for me. First, I apologize because I said I would provide a large, middle, and small cap fund stocks for you, but after reviewing my portfolios, I realized that I don't hold any small cap stocks. So it looks like I need to do a little bit of due diligence of my own and diversify a tad bit more. Consider that done. But because I want to share stocks that I actually have put monies into, I will switch the small cap selection out with a mega cap selection just to keep it fair. Now, what you're looking at on the screen are the different categories that comprise most of the stock market. For small cap companies, we have 300 billion to 200 billion in market capitalization. Mid cap companies are between 2 billion and 10 billion. Large cap companies are between 10 billion and 200 billion, and mega cap companies come in with more than $200 billion. Now for the mega cap stock, I have chosen none other than Bank of America. They are part of the financial sector and currently trading around $25 a share and just under 3% for the dividend yield. The large cap will be Cardinal Health. They are part of the health sector and currently trading around $57 per share and about 3.5% dividend yield. For the middle cap, I present Flower Foods. They are part of the consumer staples sector, trading around $23 a share and also about 3.5 for the dividend yield. And now for my low-cost index fund, I have chosen to go with Charles Schwab S&P 500 Index account. This is a fund that has a low expense ratio of just 0.02%. They're trading just over $50 a share and a little bit under 2% for the dividend yield. I have applied the buy and hold strategy to the 3 stocks and currently hold those in a Roth account. I have applied the indexing strategy to the index fund, which I hold in a taxable account. So as you can see, you can mix and match strategies and accounts and funds as you see fit. There is no one strategy that fits all. Now, one extra tidbit I want to cover today that was not really part of my original presentation, but worth noting is that Apple recently released a statement saying that it will participate in a 4-to-1 stock split at the end of this month. This means that for every share that you have of Apple, you will get an additional 3 shares once this split has been processed. It also means that a hefty share price that recently broke $400 per share will then be lowered to shares around about $100 after the split. For those of you like me who bought it in just above $100 and have been asking myself why I didn't buy more, you will now get that chance. Don't miss out on another chance to grab shares of a $1 trillion company. Okay, wow. We are at the concluding steps of this series. I commend and thank you all for taking this journey with me to create wealth for yourself. I am absolutely confident you will go forth and do great things. As a quick recap, check out part 1, download the latest CCC spreadsheet, and choose a few companies in your price range. Then choose one of the apps also covered in part 1 so that you can create a watch list and start monitoring your choices. After that, take another peek at part 2 and decide what type of account works best for you and your situation. I also want you to think about what strategies you feel more comfortable with. Remember, you can mix and match, and there are others out there for you to consider as well. Once that's done, rewatch this video if need be, choose a brokerage, create an account, and add funds so that you're ready to go when the time comes. Set up a limit order if that makes you feel more comfortable, and then you can move on with the next goal for your day, whatever that may be. Now, I've also added a few pictures at the bottom here because I think they are outstanding representations of your money working for you. So with this one, if you can buy the product making someone else rich, why not buy a piece of that company and start making yourself rich? With another stimulus check waiting in the wings, why not take that money that they give you and make it work for you? Here's a few examples of that. And for someone who only wants to manage 2 or 3 stocks, here's a good example of getting paid every month with just a few companies. In part 1, I mentioned companies pay dividends on a monthly, quarterly, and annual basis. I did forget to mention, however, that some also pay biannually. So just depending on how often you want to get a check, just a little bit of planning will go a long way. Again, I thank you for watching and taking time to invest in yourself. You can never go wrong with that. It has been a pleasure sharing and interacting with all of you. Please like, comment, subscribe, and ask questions. Let's be intentional, let's be good people, and of course, let's just invest.